This is John Paulamy of the Actionable Intelligence Alert. Today is January 28th, 2018. The chart that you see in front of you shows two price or percentage price increases of two indexes. The red and black line, squiggly line, is the oil price as represented by West Texas Intermediate Crude, which is the price in the United States. And what you see here is just the price increase over time. And you can see that since about July of last year, the price of oil is up about 45%. The blue line is the oil services stocks. These are the stocks that are engaged in drilling and completing of oil wells. And you can see that since the beginning of this year, the price of these stocks is up 8% and is significantly lagging the oil price. However, if you look at previous time frames, you will see that they are correlated pretty tightly. Sometimes the stocks outperform the price of oil, sometimes they underperform, but generally they stay fairly correlated. But yet we have this large gap here. I think this large gap represents an opportunity for speculators. I suspect that this gap will close over time. Although the oil price is currently overvalued in the short term, I think that the oil services stocks and oil stocks in general have been lagging the oil price. And the reason that this has happened is because that we have a mindset in the market right now, because of oil prices being so low for so long, that they'll stay low. We've heard lower for later, or lower for longer is the term they're using. And that has proven true up to this point. There's been a lot of information flowing around about what OPEC is going to do. They are still the largest producer in the world, OPEC collectively, about 35% of the world's production. But there's a lot of discussion around shale and how shale will is going to create this environment. We're going to have low oil prices forever. But I don't think that that's true for several reasons. That's been the scope of this particular week's conversation. I just wanted to point this out and show that, as I've said before, I think oil prices are going to head are a lot higher than people think this year. Although, like I said earlier, the oil price is currently short-term overbought. But I think there's an interesting opportunity for speculators in these oil services stocks, particularly based on the fact that they're basically coming out of near depressionary levels. We've had so many drilling companies, oil field supply companies basically go out of business. There's been tremendous consolidation, tremendous amount of bankruptcies, tremendous amount of rationalization. So I think that as the oil price heads higher this year, we will see cash flows increase, we'll see investment increase, and then we will see this gap close. And the reason why is based on a recent report that I just read from a firm that I follow. Basically, we don't have enough barrels of oil. We're using more oil than we are finding. And basically, this is the report by the firm Goehring and Rozencwajg Associates. Here's the website. They have a report that they come out with every quarter where they talk about the natural resource markets. They do long-term analysis. They do current analysis of the current markets. And they just recently came out with the fourth quarter report and for 2017, and the title was Triple-Digit Oil Prices, Are You Ready? And I'm not going to go over the whole report. It's 30 or 40 pages. I suggest that if you are interested in natural resource investing, commodities, and what I was talking about earlier with the gap between the oil price and some of the oil services. I think these folks have been spot on. You can go back into previous reports they've written where they've laid out this contrary view that they have. And I just want to point out some of the highlights from the report. Since 2007, we have consumed 360 billion barrels of oil, but only found 110 billion barrels. So that's extraordinary. That's a 250 billion barrel gap in between consumption and what we found in new reserves. And I think that's important. It gets left out of the conversation when we're talking about resource markets, and it goes back to the whole cyclicality and the contrarian nature of resource markets. We have to remember, oil markets, mining, these are extractive industries. And when you're in the oil business and you are extracting oil, if you do not, for every barrel that you find, if you do not replace it, at some point you go out of business. And I think, well, I know over the last several years as the oil price collapsed, we've had tremendous amount of, pulling in the horns, and like I described earlier, a near depression in the oil services market just because there just wasn't cash flow available to find new reserves. For example, 2017, which was last year, of course, was one of the worst years ever for reserve replacement, as the world only found 7 billion barrels of new production. So heading for higher prices. The obviously underinvestment due to low oil prices. Oil companies basically were in austerity mode. Many of them did not survive. They went bankrupt or were forced into mergers. This percolated down into the service providers, the drillers, pipe manufacturers, various other providers, pressure pumping companies. I mean, I've driven through the Eagle Ford Shale several times when it was booming, and it was unbelievable, the traffic. And now you can drive through there and you see empty yards where equipment was, various major companies that you would recognize, pressure pumping companies, all these huge yards that were filled with millions of dollars worth of equipment several years ago, completely empty now. So you can see it in real life. As I just explained earlier, oil is a depleting resource. Every barrel produced must be replaced or you eventually go out of business. It's that simple. And no one talks about that. They just assume that it's just this cornucopia, like it's a manufacturing process. You can just, click a button and make more oil. It's not that easy. And I think it's concerning that when we talk about conventional oil production, that means the non-shale production, you have people talking about drilling in these really rigorous areas, offshore Africa, deep water Gulf, the Arctic. If oil is so plentiful and there is so much of it, why are we drilling in the Arctic? Why isn't anybody even thinking about doing that? It must be the cost to do that has to be much, much higher than it is drilling in West Texas or Oklahoma or one of these places where there's a 100-year history of drilling and a tremendous amount of infrastructure. But yet we still see people drilling in the North Sea and the Arctic Circle, about this is the next frontier they're talking about. Why is this even being considered? Because quite frankly, it's very difficult to replace these barrels, and we found all the easy barrels. And that's why we've had this huge gap. Even when oil, think about it, even when oil was at very high priced, we still were not replacing the barrels being produced, that 250 billion barrel gap. As we've discussed in previous YouTube videos, demand for oil continues to grow around the world. I know everybody's talking about electric cars and Elon Musk is a demigod, but let's face the facts, folks. People in India, people in Myanmar, people in Vietnam, people in rural China, when they get enough wealth to buy a scooter or a car, they're not looking to buy a $57,000 Tesla that they have to recharge at their hut every night. That's just not how it is. There's a progression where people go to trikes and mopeds to compact cars, and these are all gasoline powered and they're cheap. I mean, Tata Motors in India can make cars for $6,000 or $7,000 or maybe even less by now, and that's what somebody's going to buy as their first car in India, and it's going to be powered by oil. So obviously, I'm hopeful that we will get off oil eventually, but it won't be happening anytime in the next several decades. It's going to take some time. So synchronous economic growth, obviously, we basically have, for the first time in about 10 or 15 years, we have worldwide growth hitting on all cylinders. All the major countries in the world are growing. Showed that last week looking at the Purchasing Managers Index. And when you have higher economic growth, or the growth in the economy, that requires more energy. You're moving more goods, moving more people. People are spending more money, going on vacations, yada, yada, yada. It translates into higher energy usage. The other thing in the report, the other thing I really wanted to talk about was, and GNR had talked about this in a previous report, but they really got in depth in this one. I was really looking forward to it, was talking about the S-curve. And I titled this slide, Understand the S-curve, It'll Make You Rich. Basically what you're looking at here is a S-curve of South Korea's oil usage. And if you look along the vertical axis, you will note that it's designated as per capita oil consumption in barrels per year per person. And if you look along the horizontal axis, you will see it's per capita real GDP. So the gray dots represent South Korea's progression as the country got wealthier. As the country's GDP went up per capita, we note that it reached a certain point of approximately between 5 and 10,000 US dollars in GDP, where oil demand basically went vertical. And we see currently that the black dots, where you see China today and India today, you see China's per capita income now reaching the stage where South Korea was when its oil consumption per capita went from about 5 barrels per person a year to 15 to 18 barrels. The difference is that there's 1.2 billion people in China. Now, if you look over to the left, you'll see India is trailing China for various reasons. But there's 1.4 billion people in China. And I know these are simplistic conversation points, but you can look at this chart. I did this exercise several years ago and looked at these charts with Korea and Japan and other countries in Asia, and even against the United States. And they all follow this same S-curve, if you will. And the numbers are so tremendous that I think it represents an excellent opportunity over the next several years. And I think that when that demand, as these countries industrialize, as these countries urbanize, the GNR goes over it in the report, urbanization, economic growth leads to higher and higher energy usage, specifically oil. And we just had the discussion previous to this slide, where we have had tremendous amount of underinvestment in new oil reserves. You start being able to connect the dots, if you will. I mean, this is the problem that you don't get in the mainstream financial press, or why most people aren't able to make huge amounts of wealth in these markets. They understand the different points, but how do you connect them all? And if we have oil demand growing, we see what the possibilities are. It doesn't even have to follow the exact S-curve of South Korea. Even if it does half of that, and we've had a tremendous amount of underinvestment, we have demand increasing. You can see that demand and supply are going to intersect at some point, and you can see that price is going to go higher. Price will move higher to ration the demand and to send the appropriate signals to producers to invest more money. The problem is, like we've discussed before, with commodities and resource markets, it's not like an app. I can't just get some Stanford computer science graduate to do an all-nighter and create an app to create more oil. It takes a tremendous amount of time, effort, and money to get new barrels. You have to go find the barrels. You have to do assessments. There's science involved. Then you have to make a determination if it's worthwhile to develop the resource. Then there's political. Most of the places where oil is being found now are not easy places to do business. Places in Africa, places in South America, places in East Asia. These places are usually bureaucratic or do not have systems in place where somebody feels comfortable dumping 10, 20, $30 billion into a project. So I think what we're seeing here is the possibility that the $100 barrel oil scenario makes sense. And I actually think it's going to go higher. Then, if you think, but if you think about some of the other turmoil in the world, if you throw in some type of crisis, who knows how high it could go. Now, I think this is a multi-year situation with the oil price. I think it's going to make a higher peak than it did before. And I think that once people reassess, like it says in the report, get out of this, they're in the current mindset, and the current zeitgeist is lower prices for longer because of shale. Part of the argument that's made in the report, which I really encourage you to read, is that U.S. shale might not be everything it's made out to be, specific to the Bakken Shale in North Dakota and the Eagle Ford Shale in Central Texas. And the insinuation in the report is that those two shales may have already peaked. So regardless, there's been such a big gap, chasm of 3 to 5 years of low investment, that is going to, as that pig moves through the pipeline, through the python, if you will, of we're going to run into a higher price environment at some point, as long as demand stays current or grows, which I expect it to do. Another thing that they talked about, like I said earlier, about India, if you go back and remember in 2001, when China was going through its huge, or 1999, 2000, China was going through its huge build out of infrastructure, and it was just amazing the amount of raw materials they were consuming. They're the largest copper consumer, the largest cement consumer, growing oil consumption every year. So India has lagged, of course. They have a larger population, but they have a different political system. I mean, the Chai Coms are able to just make people do things. This is the 5-year plan. Everyone will follow it, and everybody marches in the same direction. India is a different type of country. It's a democracy. There's different ethnic groups, different religious affiliations, so things are not as easy to get done in India. It's more tribal in its with the caste system and the different types of people living there. But with Modi now in power, he has said that he is going to move forward, the Prime Minister of India, with an infrastructure build out, electrification, roads, airports, ports. And I found it fascinating in the GNR report, this second bullet point here. India is now moving into the window of economic growth that China was in 2001 when it kicked off the last commodity supercycle. Expect India to begin impacting demand for oil and other raw materials. As I just discussed, they are going through this build out now of infrastructure, and this is going to last for 20 years. I mean, you can go look at videos of India. All India needs to do, it's one of my favorite places to put money long term. It's the biggest layup out there. All India really has to do is invest in infrastructure for the next 20 years, and that'll be enough inertia for that economy to grow at 9% every year for the next 20 years. Look at the videos. Look at the opportunity in sewage, in roads, in electrification. Look at people just catching the train in the major cities. They're hanging off the sides of the train. I mean, the whole place needs trillions of dollars of infrastructure investment. We have to acknowledge, though, that growth from India will not be the same as China, but it will impact as demand runs into constrained supply. We are seeing, not just in oil, but also in copper and some other things, guys, it's getting harder and harder to replace the produced resources. The grades are going down. We found all the easy stuff. It's getting harder and more difficult, more expensive to produce these commodities. Copper is being forecasted to be in deficit as of 2020. There's a lot of opportunity out there, and like I just showed you on this S-curve, some of these countries are haven't even hit their stride yet as far as consumption of things like oil. One other thing about India real quick, one of the interesting factoids that was in the GNR report was the fact that India has 1.4 billion people, but get this, they have less than 1,000 miles of interstate highway. That is amazing to me. So you can see where the oil demand on the S-curve chart was so low. It's about 3 to 4 barrels per person per year, and they haven't even built out their highway system yet, guys. What happens when they get to where China is, where China has 30,000 miles of highway system? They continue to build it out, and China hasn't even really got going yet on the S curve. So you can see the potential here, and you start connecting the dots. Not enough investment, not enough resources coming out of the ground on the pipeline, increasing demand, relentless increasing demand every single year. And you can see that this is going to end up in higher prices in another upcycle. Now, the only thing that could derail this thing is we had some kind of worldwide economic decline or some kind of psychotic break like we had in 2008. I don't currently see that as being the most likely situation, but it's something to watch. Obviously, if economic growth falters, demand for raw materials will go down. But that's not what we're looking at right now, at least in the next year to 18 months. So that's the update for this week. If you enjoy these videos, if you get value out of them, please subscribe on YouTube. If you have any questions or comments, put them down in the comments section and I'll answer them. I can be reached here. The website is actionableintelligencealert.com. That's where I put most of my main articles that I spend time writing, but I'm daily updating my Twitter and Facebook accounts, which are listed here, and that's more up-to-date information that I'll just throw up there. And I really follow a lot of smart people, and you'll get exposure to a lot of those ideas. That's how I found these GNR folks several years ago. So I encourage you to, if you're serious about being a speculator and want to follow my work, I would follow along at these places on Twitter and Facebook, especially because I'm updating those on a daily basis. So thanks for listening, and we'll see you next week.